Before we begin, please remember that I am not a financial advisor. The information provided in this video is for educational and informational purposes only and should not be considered financial or investment advice. The cryptocurrency market is highly volatile and carries significant risk. You should always conduct your own thorough research and consult with a qualified financial professional before making any investment decisions. Your financial situation is unique, and any decisions you make are your sole responsibility. In 2022, over $3.8 billion was stolen in crypto hacks. Let me say that again. $3.8 billion. That number is so huge it's almost meaningless. So let's make it personal. Imagine waking up tomorrow, grabbing your phone to check your portfolio, and seeing a balance of zero. Not because the market crashed, but because the platform you trusted with your hard-earned money simply vanished. One day it's a top 10 exchange with Super Bowl ads, and the next it's a Chapter 11 bankruptcy filing, with your funds trapped in a legal black hole for the next decade. This isn't a scare tactic. This is the reality that tens of thousands of Americans have faced. They did their research on a coin, they timed the market perfectly, but they missed the single most important step: choosing the right platform. And in the United States, that choice is a minefield. You're constantly bombarded with ads for platforms that promise zero fees, instant signups, and 1,000 different coins to trade. They have slick apps and celebrity endorsements. But here's the dirty little secret they don't tell you. Many of them are playing a dangerous game with US regulations. They operate in a legal gray area, and when the music stops, when the SEC comes knocking, it's your account that gets frozen. It's your money that's on the line. I'm talking about platforms that suddenly tell you they can no longer serve customers in your state. Platforms with terms of service so convoluted, they can legally use your deposited crypto for their own risky bets. Platforms whose entire operation is a house of cards, and you don't find out until a gust of wind blows it all down. The confusion is the point. The complexity is the product. They want you to be overwhelmed, so you just click agree and deposit your money without asking the hard questions. But that stops today. This video is your definitive checklist, your battle plan. We are going to cut through all the noise and give you the 5 critical, non-negotiable things you must look for in a US-based crypto trading platform. This isn't about which coin to buy. This is about building your house on solid rock instead of quicksand. By the end of this, you will have a framework that will not only protect your assets, but will give you the confidence to navigate this space like a professional. We're going to cover everything from the regulatory loopholes that can get you shut down overnight, to the hidden fees that bleed your portfolio dry. So let's get into it. The first, and by far the most important thing to look for, is ironclad security and transparent proof of reserves. This is point number 1, and it is the foundation for everything else. If an exchange fails on this point, nothing else matters. Your potential gains are irrelevant if your principal can be stolen in an instant. The old crypto saying is, not your keys, not your coins. And while holding your own crypto in a hardware wallet is the ultimate security goal for long-term holds, the reality is you have to use an exchange to trade. When you do that, you are trusting them to be the custodian of your assets. You are trusting their security. So how do you verify that trust? First, the basics. Two-factor authentication, or 2FA, is not optional. It's the bare minimum. If a platform doesn't require it, close the tab and never go back. But not all 2FA is created equal. SMS-based 2FA, where they text you a code, is better than nothing, but it's vulnerable to something called a SIM swap attack, where a hacker tricks your cell provider into porting your number to their phone. The gold standard is an authenticator app like Google Authenticator or Authy. It's a simple, free app on your phone that generates a time-sensitive code, completely independent of your phone number. A top-tier exchange will not only support this but will practically force you to use it. They should also offer advanced security features like address whitelisting, which prevents withdrawals to any crypto address you haven't pre-approved. These aren't fancy add-ons. They are fundamental seatbelts in a world of high-speed collisions. Next, you need to look for how they store your assets. This is huge. Ask this question: what percentage of customer funds are held in cold storage? Cold storage simply means the crypto is stored on devices that are not connected to the internet. Think of it like a bank vault. The hot wallet is the teller's drawer. It has enough cash for daily transactions, but the vast majority of the money is locked away offline, safe from bank robbers, or in our case, hackers. A reputable exchange will be very public about this. They will proudly state that 95%, 98%, or even more of their digital assets are in cold storage. They'll also talk about being geographically distributed and requiring multiple high-level employees to access the funds. If you have to dig through pages of legal documents to find this information, that's a massive red flag. They should be screaming it from the rooftops. Now let's talk about insurance. In the traditional banking world, your cash deposits are protected by the FDIC up to $250,000 if the bank fails. Some US-based crypto exchanges have extended this protection to the US dollar balances you hold on their platform. This is a critical feature. It means the cash you have sitting there waiting to be deployed is safe. But what about the crypto itself? The crypto is not FDIC insured. However, the best exchanges carry private insurance policies from firms like Lloyd's of London to protect against theft from a security breach or hack. You need to read the fine print here. This insurance often only covers a breach of their hot wallets, not a case where your individual account is compromised due to your own security lapse. Still, it's a powerful indicator that the company takes security seriously and has the financial backing to weather a storm. Finally, the new security benchmark in a post-FTX world: proof of reserves. This might sound technical, but the concept is simple. It's an audit that proves an exchange actually holds the customer assets it says it does, one-to-one. For years, platforms just expected you to trust them. FTX showed us that trust is not enough. Proof of reserves uses cryptographic methods, often a Merkle tree, to allow you, the user, to anonymously verify that your specific balance was included in the audit without revealing anyone's private information. Think of it like a public accounting of all the assets held in trust. A top-tier US-based platform will not shy away from this. They'll have a dedicated proof of reserves or transparency page on their website. They will conduct these audits regularly with reputable third-party firms and make the results public. If an exchange says, "Just trust us," run. The new standard is "Don't trust, verify." So your action item is to go to the website of any exchange you're considering and look for that transparency page. See when their last audit was. See if they explain their process. This single act of due diligence can save you from catastrophic loss. So, to recap, point 1, you're looking for mandatory high-level 2FA, a public commitment to holding over 95% of assets in insured cold storage, FDIC insurance on your cash balances, and most importantly, regular, transparent third-party proof of reserves audits. This is your security checklist. It's the first gate you must pass through. But here's the catch. You could find the most secure, technically brilliant platform in the world, a true digital Fort Knox. But if it isn't compliant with US law, it's a ticking time bomb. One letter from a regulator could shut it down tomorrow, and all that security won't mean a thing when your assets are frozen indefinitely. And that's why the second thing you must look for, US regulation and compliance, is the one that separates the legitimate players from the casinos waiting to be shut down. Think about the biggest crypto exchange meltdowns in history. FTX, Celsius, Voyager. What did they all have in common? They operated in a gray area, a regulatory no man's land, often based offshore, far from the reach of US law. They were financial casinos, and when the house of cards collapsed, millions of Americans lost everything with virtually no legal recourse. That's not a risk. That's a certainty waiting to happen. Choosing a platform that is deeply rooted in US regulation isn't about limiting your options. It's about building your crypto journey on a foundation of solid rock instead of shifting sand. So what does US regulation and compliance actually mean? It's not just a fancy phrase for a company's legal department. It's a complex, multi-layered shield protecting you, the user. Let's break down the shield piece by piece, starting with the big guns, the federal agencies. You've probably heard of the SEC, the Securities and Exchange Commission. In the world of crypto, they are the ghost in the machine. Their central question is this crypto asset a security? A security, in simple terms, is an investment contract. You put money in, expecting a profit based on the efforts of others, like buying a stock. If the SEC decides a token is an unregistered security, they can bring the hammer down. They can sue the project, force exchanges to delist the token, and cause its value to plummet overnight. Remember the Ripple XRP lawsuit? The price of XRP cratered, and major US exchanges like Coinbase were forced to halt trading, leaving countless investors stuck with bags they couldn't sell. A compliant US platform is constantly navigating this minefield for you. They have teams of lawyers analyzing which assets are safe to list and which ones carry too much regulatory risk. When you see a US-based exchange with a more curated, boring list of coins compared to an offshore casino offering thousands of meme coins, that's not a weakness. That is a strength. It's a sign that they are actively protecting you from the regulatory crossfire. They are choosing long-term stability for their customers over the short-term profits of listing the latest hype coin that could be deemed an illegal security tomorrow. Next up is the CFTC, the Commodity Futures Trading Commission. While the SEC worries about securities, the CFTC governs commodities, things like oil, gold, and Bitcoin. That's right. Bitcoin and likely Ethereum are generally considered commodities in the US. If you're using a platform that offers futures, options, or other complex derivatives on Bitcoin, you want them to be under the watchful eye of the CFTC. This ensures fair market practices and prevents the kind of wild manipulation that can liquidate your position in a heartbeat. A CFTC-regulated platform is playing by the established rules of major financial markets, not making them up as they go along. But perhaps the most important and most personal piece of this federal puzzle is a little agency called FinCEN, the Financial Crimes Enforcement Network. FinCEN is a bureau of the Treasury Department, and their job is to fight financial crime. This is where those infamous acronyms, KYC and AML, come into play. AML stands for anti-money laundering. KYC, or Know Your Customer, is the process that enforces it. When you sign up for a legitimate US exchange and they ask for your name, address, social security number, and a picture of your driver's license, that's KYC. And I know it feels intrusive, feels like a hassle. Your gut reaction is, why do they need all this? Isn't crypto supposed to be anonymous? Here's the critical truth. KYC is not there to spy on you. It's there to protect you. A platform that doesn't enforce strict KYC is a giant, flashing neon sign for criminals, terrorists, and scammers. They can use the platform to launder illicit funds with impunity. And when, not if, the government discovers this, they won't just go after the bad actors. They will shut down the entire platform. They will freeze every single asset. Your funds, completely legitimate and hard-earned, will be locked up in a legal nightmare for months, or even years, alongside the criminal's money. That KYC process, that 5-minute inconvenience of uploading your ID, is the firewall that keeps your money from being commingled with the proceeds of crime. A platform that takes this seriously is a platform that takes your safety seriously. They are registered as a money services business, or MSB, with FinCEN, and they follow the rules. A platform that advertises no KYC is not offering you freedom. They are offering you a front-row seat to a catastrophic implosion. Now, federal oversight is just one layer. The United States is not one single market. It's 50 different ones. This brings us to the headache of state-level regulation, and it is absolutely crucial. The most famous or infamous example of this is New York's BIT license. It's a notoriously difficult and expensive license to obtain for any company wanting to offer crypto services to New York residents. Many companies decided it wasn't worth the trouble and simply blocked New Yorkers from using their platform. Why should you, a potential user in, say, Florida or Ohio, care about a New York license? Because a platform's willingness to tackle the toughest state regulations is a powerful signal. It shows they have the capital, the legal expertise, and the long-term commitment to operate legally across the entire country. They aren't just cherry-picking the easy states. They're building a compliant business meant to last. When you're vetting a platform, look for a map or a list of states where they are licensed to operate. The more states, the better. It's a direct indicator of their regulatory maturity and financial stability. So how can you, the average person, verify all this? It's easier than you think. Go to the platform's website and scroll all the way down to the footer. Click on the Legal, Licenses, or About Us links. Legitimate platforms are proud of their compliance. They will list their licenses and registrations. They'll state that they are a registered MSB with FinCEN. They might even list their individual state money transmitter licenses. If you can't find this information easily, that is a massive red flag. Transparency is the hallmark of a trustworthy exchange. Contrast this with the offshore trap. You see an ad for an exchange based in some remote island nation. They promise 100x leverage. They promise you can trade thousands of obscure coins. They promise no KYC, just an email and you're ready to go. It's incredibly tempting. It feels like the true spirit of crypto. But you are trading on a platform with zero accountability to you as a US citizen. If they get hacked and your funds disappear, who do you call? The SEC? The FBI? They have no jurisdiction. If the platform decides to freeze your withdrawals because of suspicious activity, who do you appeal to? There is no one. It's their casino, their rules. Your money is gone. Choosing a US regulated platform is like putting your money in a real bank versus handing it to a stranger in an alley who promises a higher interest rate. The bank has rules, it has oversight, it has insurance. The stranger has promises. The regulatory framework in the US isn't perfect, and it's still evolving. But it provides a fundamental layer of due process and protection that is completely absent elsewhere. It ensures the company is real, that it's held accountable for its actions, and that there is a legal framework to turn to when things go wrong. It's the single most important factor in ensuring the long-term safety of your assets. But even the most compliant, secure, and regulated platform on Earth can be a terrible choice if it slowly bleeds you dry with every single transaction. Because hidden beneath the safety of US law are the complex and often predatory pricing models designed to take a slice of your profits at every turn. And that brings us to the third critical thing you must scrutinize: the dark world of fees, spreads, and the true cost of trading. Tie of US law are the complex and often predatory pricing models designed to take a slice of your profits at every turn. And that brings us to the third critical thing you must scrutinize: the dark world of fees, spreads, and the true cost of trading. Imagine you go to a fancy restaurant. The menu has prices, you order, you enjoy your meal, and then the bill comes. But underneath the total, there's a line item you've never seen before: a kitchen staff appreciation fee of 4%, and a table linen service charge of 2%, and a mandatory 20% gratuity. Suddenly, that $100 meal costs you $130. You feel cheated, right? Deceived. Because the true cost was hidden from you. Welcome to the world of crypto trading platforms. Many of them operate on this exact model, and their goal is to bleed you dry with 1,000 tiny cuts you never see coming. The most obvious fee, the one they put on the menu, is the trading fee. This is usually presented in what's called a maker-taker model. Sounds complex, but it's simple. A maker is someone who makes the market by placing an order that doesn't get filled immediately, like setting a limit order to buy Bitcoin if it drops to $60,000. You're adding liquidity and order waiting on the books. A taker is someone who takes liquidity off the market by placing an order that fills instantly, like hitting the buy now button at the current market price. Why does this matter? Because platforms reward makers with lower fees and penalize takers with higher fees. They want their order books to look full and active. So, as a taker, the person just trying to get into a trade quickly, you might pay a 0.6% fee. On a $10,000 trade, that's $60 gone just for the privilege of clicking a button. A maker might only pay 0.4% or $40. Seems small, but think about it. If you make 100 trades a year, that difference adds up to thousands of dollars. And here's the kicker. These fees are almost always tiered. The massive hedge funds and whales trading millions of dollars a day, they get huge discounts, paying fees as low as 0.02% or even zero. The platform subsidizes those big players by charging you, the retail trader, the absolute highest rates. You are paying the price for their convenience. But trading fees, as annoying as they are just the tip of the iceberg. They are the fee on the menu. The real killer, the hidden charge that robs most new traders blind, is the spread. The spread is the silent assassin of your portfolio. If you've ever exchanged currency at an airport, you've been a victim of the spread. You see a board that says they buy US dollars for 0.90 euros, but they sell US dollars for 0.95 euros. That 5-cent difference is their profit. It's the gap between the buy price and the sell price. That's the spread. Crypto platforms do the exact same thing, but on a massive digital scale. The spread is the difference between the highest price a buyer is willing to pay for a coin, called the bid, and the lowest price a seller is willing to accept, called the ask. On a good liquid platform, this gap is tiny, a fraction of a penny. But on many US-based platforms, especially the ones that advertise zero commission or fee-free trading, the spread is a canyon. This is their business model. They aren't a charity. When they say zero fees, what they mean is, we're not going to show you a line item for the fee. Instead, they build their profit directly into the price of the asset. Let's say the true global market price of Ethereum is $3,000. On a platform with a wide spread, they might offer to sell it to you, the buyer, for $3,030. And if you wanted to sell it, they'd only offer to buy it from you for $2,970. That $60 gap is the spread. The moment you clicked buy, your investment was already down 1%. You paid a $30 fee you never saw. And if you turned around and sold it 1 second later, you'd lose another $30. You would have paid a 2% round-trip fee without ever seeing the word fee on your screen. This is how they get you. They prey on the idea that you're getting a deal, that it's free, while quietly skimming a huge percentage off the top of every single transaction. A transparent 0.6% trading fee is infinitely better than a hidden 2% spread. So let's follow the money. You've been hit by the trading fee. You've been crushed by the spread. Surely you're safe now, right? Wrong. Now you have to deal with deposit and withdrawal fees. Want to fund your account? An ACH bank transfer is usually free but slow. A wire transfer? That'll be $25, please. Want to use your debit card for an instant deposit? That's the most convenient, so of course it's the most expensive. They'll slap you with a 3.5% or even 5% fee, blaming it on credit card processors, but you can be sure they're adding their own slice on top. Depositing $1,000 with your card could cost you $50 before you've even made a single trade. But the real pain comes when you want to take your crypto off the platform, which you absolutely should do if you're holding it long term. This is where they hit you with crypto withdrawal fees. Every crypto transaction has a network fee, or a gas fee, that pays the miners or validators who secure the network. That's unavoidable. But many platforms will charge you a network fee plus their own, arbitrary, flat-rate withdrawal fee. For example, the actual network cost to send Bitcoin might be $5 at that moment, but the platform will charge you a flat rate of 0.0005 Bitcoin. When Bitcoin is at $60,000, that's a $30 fee. They pocket the $25 difference. They are profiting by holding your own assets hostage. They make it expensive to leave, creating a walled garden where your money is slowly siphoned away. Let's put this all together in a real-world horror story. Meet Sarah, a new investor. She signs up for a slick, easy-to-use app that promises fee-free crypto trading. She's excited. She deposits $2,000 with her debit card. Boom! A 4% fee hits her immediately. Her $2,000 deposit is now $1,920 in her account. She didn't even notice. She decides to buy a hot new altcoin. She puts all her money in. The app shows her a price. She clicks buy. What she doesn't see is the 2.5% spread baked into that price. Her $1,920 is now worth $1,872 instantly. The coin does well. It pumps 20% over the next week. Sarah is ecstatic. She sees her balance is now $2,246. She thinks she's a genius. She decides to take profit. She clicks sell. Wham! She gets hit with the spread again on the way out, another 2.5%. Her balance drops to $2,189. Now she wants to withdraw her money, her hard-earned profit, back to her bank account. The platform charges a one-time $25 withdrawal fee. Her final take-home amount is $2,164. She started with $2,000. She made what she thought was a brilliant 20% trade. But after all the hidden fees, the spread, the deposit and withdrawal charges, her actual profit was just $164. The platform, through its gauntlet of hidden costs, devoured more than half of her profits. And Sarah is one of the lucky ones who actually made money on the trade. Imagine if the coin had gone down. Those fees would have amplified her losses into a catastrophic event. So how do you protect yourself? You have to become a fee detective. First, before you even sign up, find the platform's fee schedule or pricing page. Some platforms bury this deep in their website. If you can't find a clear, simple chart explaining every single fee, maker/taker percentages, withdrawal costs, deposit fees, run away. Transparency is not optional. Second, test the spread yourself. You don't need a fancy tool. Just open the platform you're considering and compare it to a major, professional exchange or a site like CoinMarketCap. Look at the buy price and the sell price for Bitcoin or Ethereum. Is the gap on your platform a few cents? Or is it a few $100s? Do this for less popular altcoins too, where the spreads are often much worse. A platform that seems cheap for Bitcoin might be robbing you blind on everything else. The illusion of free is the most expensive lie in this industry. A platform with a clear, upfront 0.5% trading fee is 100 times more honest and often cheaper than a zero-commission app that murders you with a 3% spread. You must calculate the true cost of a round-trip trade, buying and then selling, to understand what you're really paying. Because every fraction of a percent they take is a fraction you have to beat just to break even. These fees are a constant, gravitational pull against your success, and choosing the right platform is the only way to escape their orbit. So you've navigated the minefield of fees. You found a platform where the cost of doing business doesn't eat you alive. But paying a low entry fee to a store with empty shelves is a fool's errand. This brings us to the third critical thing you must look for in a US-based crypto platform: asset selection and its inseparable twin, liquidity. Because what you can trade and how easily you can trade it will define your entire crypto journey. Let's start with asset selection. On the surface, this seems simple. Does the exchange have the coins you want to buy? But it goes so much deeper than that. In the early days, if a platform had Bitcoin and Ethereum, you were set. Today, the crypto universe has expanded into a sprawling galaxy of thousands of assets, each with its own story, its own technology, and its own potential. We have altcoins, we have DeFi tokens, we have metaverse coins, we have layer 1 and layer 2 solutions, we have stablecoins pegged to everything from the dollar to gold. Choosing a platform with a limited selection is like deciding you want to be a master chef, but your only grocery store just sells potatoes and salt. You might be able to make a few decent dishes, but you'll never create a masterpiece. You'll never have the chance to experiment with exotic ingredients, to find that one unique flavor that changes everything. The crypto market moves at the speed of light. Narratives shift in a week. A project that's unheard of on Monday can be the talk of the town by Friday. If your platform is slow to list promising new assets, you're stuck on the sidelines, watching from the window as the parade goes by. Think about the people who wanted to invest in Solana or Avalanche early on. They weren't trading on every major US exchange at first. Early investors had to seek out platforms that were willing to list these assets before they became household names. By the time the most conservative, slow-moving exchanges finally listed them, a significant portion of the explosive growth had already happened. This is where the challenge for US-based traders becomes particularly sharp. You might look at an international exchange and see a menu of 500 different coins. Then you look at a major US-regulated exchange and see maybe 150. Why the massive difference? Comes down to one thing: regulatory fear. In the United States, the Securities and Exchange Commission, the SEC, looms large. The central question they ask is whether a particular crypto asset is a security, like a stock in a company. The legal test for this, called the Howey test, is decades old and notoriously difficult to apply to this new technology. The result? US exchanges are terrified of listing a coin that the SEC might later declare an unregistered security. The legal battles could be catastrophic. So they take an extremely cautious approach. They have teams of lawyers who vet every single asset, a process that can take months, even years. This protects them, and in some ways it protects you from outright scams. But it also means you lose access to a huge swath of the innovative, high-risk, high-reward part of the market. You're getting a curated, sanitized version of the crypto world. So you have to ask yourself, what kind of investor are you? Are you here for the blue-chip, established projects like Bitcoin and Ethereum? If so, a platform with a smaller, more curated list might be perfect for you. Or are you a crypto explorer, looking to venture into the uncharted territories of smaller-cap altcoins? If that's you, you need a platform that shares your appetite for discovery, even if it means accepting a different level of risk. But here's the crucial catch. Finding a platform that lists the coin you want is only half the battle. This brings us to the twin concept: liquidity. You can find the most obscure, promising altcoin on the planet listed on an exchange, but if there's no liquidity, that listing is worthless. It's a trap. So what is liquidity? In the simplest terms, it's the ability to buy or sell an asset quickly without causing a major change in its price. Imagine two different markets. The first is a massive, bustling farmers market in the middle of a city. There are hundreds of sellers with apples and thousands of buyers who want apples. If you want to sell a crate of apples, you can do it almost instantly at the going market price. If you want to buy a crate, same thing. That market is highly liquid. Now imagine a tiny roadside stand on a deserted highway. There's one guy selling a few apples and maybe one car drives by every hour. If you show up wanting to sell a whole crate of apples, the owner might say, "I don't have that many customers. I'll give you a quarter of the price." You have to take a huge loss just to make the sale. If you want to buy a crate, he might say, "You're my only customer all day. I'm going to charge you double." That market is illiquid. In crypto trading, low liquidity manifests in two terrifying ways: slippage and getting trapped. Slippage is the silent killer of profits. It's the difference between the price you expected to pay and the price you actually paid. Let's say you see a coin trading at exactly $1. You decide to buy 10,000 of them, so you place a market order for $10,000. But the exchange is illiquid. There are only 1,000 coins for sale at $1. To fill your order, the exchange has to start buying the next available coins, which are listed for $1.01. Then the next batch at $1.02. By the time your entire order of 10,000 coins is filled, your average purchase price isn't $1. It's $1.03. You just lost 3% or $300 the second you click the buy button. That's slippage. It's a hidden fee, a tax on low liquidity, and it will bleed your account dry over time. But slippage is nothing compared to the ultimate nightmare: being completely unable to exit your position. Picture this. You found a small cap gem. You invested a few $1,000s. And it happens the coin goes on a parabolic run. It's up 500%. Your investment is now worth a life-changing amount of money. Your heart is pounding, your hands are shaking, you go to sell. You hit the market sell button. And nothing happens. Or worse, the price instantly plummets 40% because your sell order was so large it absorbed every single buyer in the order book. There's just no one on the other side of the trade to buy what you're selling. You watch in horror as the price collapses back down, and your paper profits evaporate into thin air because the market was a mirage. There was no real depth, no liquidity. You were trapped. This is not a hypothetical scenario. It happens all the time on smaller, illiquid exchanges and with obscure coins. So how do you protect yourself? How do you check for this? First, for asset selection, it's easy. Simply go to the exchange's website and find their list of supported assets or markets. See if the coins you're interested in, and the types of coins you might be interested in down the road, are there. For liquidity, it's a bit more detective work. The number one indicator is trading volume. Most exchanges show the 24-hour trading volume for each trading pair. A pair like BTC/USD on a major exchange might have billions of dollars in volume. An obscure altcoin on a small exchange might have a few thousand. Higher volume is almost always a sign of better liquidity. The second place to look, if the platform offers it, is the order book. The order book is a live list of all the current buy and sell orders. You don't need to be a pro trader to read it. Just look at the list of buy prices and sell prices. Are they tightly packed together, with large amounts of coins available at each level? That's a deep order book, a sign of good liquidity. Or are there huge gaps between the prices? Does it look like one large order could wipe out 10 price levels at once? That's a thin order book, a massive red flag. Finally, use third-party data aggregators. Websites like CoinMarketCap and CoinGecko rank exchanges not just on their reported volume, but on a combined liquidity score that analyzes order book depth and other factors. If a US-based exchange is consistently ranked in the top tier on these sites, you can be confident that for the assets it does list, you'll be able to trade them efficiently and without drama. Ultimately, there's a fundamental trade-off. The platforms with the widest selection of new and exotic altcoins are often newer, less regulated, and may have questionable liquidity. The big, established, US-regulated platforms will have incredible liquidity and security, but a much more limited selection of assets. Your job is to find the right balance for your goals and your risk tolerance. Don't just be lured in by a massive coin list. And don't settle for a platform that will never list the assets you believe in. Do the research. Check the volume. Glance at the order book. You've now found a secure platform. You've minimized your fees. You've confirmed it has the assets you want and the liquidity to trade them effectively. You're ready to go, right? Not quite. Because all of this is meaningless if the platform itself is impossible to use. What good is a Ferrari if the steering wheel is on the roof and the gas pedal is in the trunk? The platform's interface, the tools it provides, and how it feels to actually place a trade can be the difference between a seamless, profitable experience and a frustrating, costly mistake. This brings us to the third critical thing you must look for in a US-based crypto platform. Its user interface and user experience, or UI and UX. Now, I know those sound like tech bro buzzwords, but let's break it down into what it actually means for your money. UI is what you see, the buttons, the charts, the colors. UX is what you feel. Is it intuitive? Is it frustrating? Is it fast? It's the difference between a tool that feels like an extension of your own mind and one that actively fights you every step of the way. Think about it. You wouldn't trust a surgeon who uses rusty, poorly designed tools. So why would you trust your hard-earned capital to a trading platform that's cluttered, confusing, and slow? This isn't just about aesthetics. A bad interface can directly lead to financial loss. You accidentally hit the market sell button instead of limit sell because they were poorly labeled and too close together. You misread a chart because the data was presented in a confusing way. You couldn't find the stop-loss feature in a panic and a small dip turned into a catastrophic loss. These aren't hypotheticals. These are horror stories that happen every single day to traders on poorly designed platforms. So, what separates the good from the bad? First, let's talk about the beginner's experience. A great platform doesn't throw you into the cockpit of a 747 on your first day and expect you to fly. It understands that most users aren't day trading veterans. The dashboard should be clean, clear, and focused on the essentials. Your portfolio balance, the top moving coins, and a simple buy and sell button. That's it. It should be as easy to buy $100 of Bitcoin as it is to order a pizza on an app. Some platforms get this horribly wrong. They bombard you with a dozen different charts, a streaming news feed, complex order books, and flashing numbers that look like something out of the Matrix. This is designed to make the platform look professional and powerful, but what it actually does is create analysis paralysis. You're so overwhelmed with information that you don't know what to focus on, and you end up making no decision at all, or worse, a rash one based on the wrong data point. A world-class platform for beginners prioritizes clarity over clutter. It guides you. It makes the complex world of crypto feel accessible, not intimidating. But here's the crucial next step. The platform must be able to grow with you. What's perfect for a beginner is often too simplistic for an intermediate or advanced trader. This is where the concept of a pro or advanced mode comes in. The best platforms offer a simple, streamlined interface by default, but allow you to unlock a much more powerful and customizable suite of tools with the click of a button. This is where you get to arrange your workspace just the way you like it. You want to see the Bitcoin/Ethereum chart next to the real-time order book and have 5 different technical indicators running at once? A great platform lets you do that. It doesn't lock you into a one-size-fits-all view. It should offer a robust charting package, often powered by something like TradingView, which is the industry standard. This means you get access to hundreds of indicators, drawing tools, and analytical overlays. You can draw trend lines, map out support and resistance, and apply Fibonacci retracements right on the platform without needing a separate tool. It also means offering a full spectrum of order types. A beginner might only use market buy, which just buys at the current best price. But as you become more sophisticated, you'll want to use limit orders to set a specific price you're willing to pay, and stop-loss orders to automatically sell if the price drops to a certain level, protecting you from major losses. You might even want to use more complex orders like take profit or trailing stops. A platform that only offers the most basic order types is telling you it's not serious about trading. It's a crypto vending machine, not a professional-grade exchange. The ability to switch between a simple, clean view and a powerful, customizable trading terminal is a hallmark of a top-tier platform designed for long-term success. Now let's talk about the place where most people interact with their crypto, their phone. The mobile experience is not an afterthought. For many, it's the primary experience. A platform can have the most beautiful, powerful desktop interface in the world, but if its mobile app is clunky, slow, or missing key features, it's a massive failure. The crypto market never sleeps. It's open 24/7/365. A major price swing can happen at 3 a.m. on a Sunday while you're on vacation, hundreds of miles from your computer. In that moment, your phone is your only lifeline to your portfolio. You need to be able to do everything on the app that you can do on the desktop. That means viewing advanced charts, placing complex order types, and managing your positions with speed and precision. Imagine this scenario. News breaks that causes a market-wide panic. You see your portfolio value plummeting. You need to sell a position immediately to cut your losses. You pull out your phone, open the app, but it takes 10 seconds to load. Then you tap to sell, but the app freezes for another 5 seconds. By the time the order finally goes through, the price has dropped another 10%. That lag, that poor mobile design just cost you real money. Thousands of dollars, potentially. When you're evaluating a platform, download the app. Sign in. Navigate through it. Does it feel snappy and responsive? Can you easily find all the critical functions? Does it crash or lag? Read the reviews in the App Store or Google Play Store, but take them with a grain of salt. Actually test it yourself. The quality of a platform's mobile app is a direct reflection of how much they value their users' ability to manage their money effectively, wherever they are. Finally, let's touch on a subtle but absolutely vital component of user experience: performance and speed. This is about the underlying engine of the platform, not just the shiny exterior. In a market where prices can fluctuate by several percent in a matter of seconds, the speed of your trade execution is paramount. When you click buy, you expect your order to be filled almost instantly at the price you saw on the screen. However, on slower, less robust platforms, you can experience something called slippage. Slippage is the difference between the price you expected to get and the price you actually got. If you're trying to buy Bitcoin at $50,000, but the platform is slow and by the time your order is processed, the price has jumped to $50,050, that $50 difference is slippage. It's a hidden cost of using a bad platform. In a fast-moving market, slippage can eat away at your profits or amplify your losses on every single trade. Top-tier platforms invest hundreds of millions of dollars into their matching engines and infrastructure to ensure lightning-fast execution and minimal slippage. They have servers co-located in major financial data centers to reduce latency to mere milliseconds. You won't see this on their marketing page, but you will feel it when you trade, especially during periods of high volatility when everyone is rushing for the exits or piling into a rally. This is when weaker platforms freeze, crash, or show you the dreaded unable to process your request error, while the elite platforms continue to execute trades flawlessly. So, how do you test all of this without risking your life savings? Simple. You test drive them. Just like you wouldn't buy a car without getting behind the wheel, you shouldn't commit to a platform without using it first. Open an account on 2 or 3 of your top choices. Most US-based platforms have free and easy sign-up processes. Use their demo or paper trading feature if they have one. This lets you trade with fake money in a real market environment. See how it feels. Place some fake trades. Set up some fake stop losses. Get a feel for the workflow. If they don't have a demo account, deposit a very small, insignificant amount of money, say $20, an amount you absolutely wouldn't care if you lost. Then execute a real trade. Buy $10 of something and immediately sell it. Go through the entire process. How easy was it? How fast was it? Did the final price match what you saw on the screen? Check the mobile app. Do the same thing. This small investment of time and a few dollars can save you thousands in lost funds and frustrated headaches down the road. The look and feel of a platform is not a superficial feature. It is the core of your trading experience. It dictates your efficiency, your confidence, and in many cases, your profitability. A great interface empowers you to make smart, timely decisions, while a poor one puts obstacles in your path and can turn a winning strategy into a losing one. But even the most beautiful, intuitive, and lightning-fast platform in the world has a dark side if it's secretly draining your account with every single click. Which brings us to the fourth, and perhaps the most misunderstood, aspect of choosing an exchange: the fees. They're the silent assassins of your portfolio. The tiny numbers in the fine print designed to be confusing, designed to be overlooked. And exchanges, well, they are masters of this game. They know that if they can make their fee structure just complicated enough, most people will just throw up their hands, click buy, and accept whatever charges come their way. But not you. Not after this. Understanding an exchange's fee structure isn't just about saving a few bucks. It's the fundamental difference between building wealth and unknowingly bleeding it away, one transaction at a time. Let's demystify this. There are 3 main ways an exchange will take a cut of your money: trading fees, the spread, and withdrawal fees. First, let's talk about the most common one, the trading fee. This is what you're charged for the simple act of buying or selling a cryptocurrency. In the US, most reputable exchanges use what's called a maker-taker model. And I know that sounds like industry jargon, but stick with me because understanding this one concept will put you in the top 10% of crypto investors. Imagine a local farmer's market. You have farmers who bring their produce to the market to sell. They are making the market. They are providing the apples, the carrots, the liquidity. Then you have customers who show up and buy whatever is available right there on the spot. They are taking from the market. They are taking the produce, the liquidity that the farmers provided. A crypto exchange works the exact same way. A maker is someone who places an order that doesn't get filled immediately. You're adding your order to the order book, creating liquidity for others. Think of placing a limit order to buy Bitcoin, but only if the price drops to $50,000. Your order is now sitting there, waiting, adding to the market's depth. You are the farmer. Because you are providing a service to the exchange by adding liquidity, the exchange rewards you with a lower fee, the maker fee. A taker, on the other hand, is the customer at the market. You want your crypto and you want it now. You place a market order, which executes immediately at the best available current price. You are taking liquidity from the order book that the makers provided. For this convenience of an instant transaction, the exchange charges you a slightly higher fee, the taker fee. So why does this matter? For a long-term investor who buys once a month, the small difference between a maker and taker fee might not seem like a big deal. But for an active trader, it's everything. Those small percentage differences, compounded over hundreds or thousands of trades, can be the difference between a profitable year and a losing one. Top-tier US exchanges will have a tiered fee structure. This means the more you trade in a 30-day period, the lower your maker and taker fees become. They're rewarding their most active customers. When you're comparing platforms, don't just look at the base fee. Look for their fee schedule. See what it takes to climb the tiers and reduce your costs over time. Now let's talk about the sneakiest fee of them all. The one that allows some platforms to scream zero-fee trading from the rooftops. This is called the spread. If you've ever exchanged currency at an airport, you've been a victim of the spread. You see a sign that says they buy euros for $1.10, and right next to it, a sign that says they sell euros for $1.20. That 10-cent difference? That's the spread. It's their profit margin baked directly into the price. They're not charging you a fee, but they are most certainly making money. Crypto platforms that target beginners often do the exact same thing, but on a digital scale. They offer a simplified interface with a big, friendly, buy button. There's no complex order book, no maker-taker nonsense. Seems so easy, but when you click that button, look closely. The price you're paying for Bitcoin might be $60,050. But if you were to immediately click the sell button, the price they'd offer you might be $59,950. That $100 difference is the spread. They're not charging you a 0.5% trading fee. They're just selling you the asset for 0.25% more than it's worth and offering to buy it back for 0.25% less than it's worth. It feels free, but it can often be far more expensive than a platform with a transparent, low-percentage taker fee. The cardinal rule is this: there is no free lunch. If a platform claims to have no fees, your first question should be, what's your spread? Because that's where they're making their money, and it's coming directly from your pocket. Finally, we have the third category: deposit and withdrawal fees. This is about getting your money onto and, more importantly, off of the exchange. Getting US dollars onto a platform usually comes with a few options. The most common is an ACH transfer from your bank account. This is typically free on most major exchanges, but it can be slow, sometimes taking 3 to 5 business days for the funds to clear and become available for withdrawal. If you want speed, you can often use a debit card or a wire transfer. Wires are fast but usually come with a flat fee from both your bank and the exchange. Debit card purchases are instant, but watch out. This is often where platforms charge their highest fees, sometimes as much as 3 to 4% of your purchase amount. That convenience comes at a steep price. But the most overlooked fee, and one that can cause the most frustration, is the crypto withdrawal fee. Let's say you've bought some Ethereum and you want to move it to your own self-custody wallet like a Ledger or a Trezor, which is something you absolutely should be doing for long-term storage. To do this, you have to pay the network's transaction fee, also known as the gas fee. This fee doesn't go to the exchange. It goes to the miners or validators who secure the network. However, many exchanges will add their own flat fee on top of that network fee. Some exchanges charge a dynamic fee that reflects the real-time cost of the network, which is fair. Others charge a fixed, and often inflated, flat fee. This might be a small amount of ETH or a fraction of a Bitcoin. It might not seem like much, but if you're someone who plans to frequently move assets to participate in DeFi or simply to secure your coins, these withdrawal fees can add up to a shocking amount over time. Before you commit thousands of dollars to an exchange, do a test. Go to their withdrawal page and see what they quote to withdraw a popular asset. Compare that to other exchanges. This is a critical piece of due diligence that 99% of people skip. So how do you put this all together? You have to define what kind of crypto user you are. Are you the accumulator, who just wants to buy a set amount of Bitcoin and Ethereum every month with the lowest possible purchase fee? If so, a platform that offers free ACH deposits and a simple, competitive spread might be perfect for you. The complexity of a maker-taker model is irrelevant. Or are you the active trader, who will be executing dozens of trades a week, trying to capitalize on market movements? For you, the maker-taker fee is everything. You need to find the platform with the lowest trading fees and the best volume tiers, because that's where you'll save the most money. The spread on a simple platform would destroy your profits. Or perhaps you're the self-custody champion, who sees exchanges as just a temporary on-ramp. You buy your assets and immediately move them to your own wallet. For you, the number one priority is finding an exchange with the lowest, most transparent crypto withdrawal fees. Don't let anyone tell you there is one best platform. The best platform is the one whose fee structure is aligned with your strategy. Do the homework. Read the fee schedule. It might be the most boring page on their website, but it's also the most important. But finding a platform with the perfect fee structure for you is only half the battle. Because what good are low fees if the exchange doesn't even list the assets you want to buy? That brings us to our fifth and final crucial element: coin selection and the hidden dangers of having too much choice. At first glance, this seems simple. If you want to buy Dogecoin, you need a platform that sells Dogecoin. If you're a big believer in Solana, you find an exchange that lists SOL. It's like shopping for groceries. You go to the store that has the items on your list. And for the vast majority of people entering the crypto space, their list is pretty short: Bitcoin, Ethereum, and maybe one or two other large, well-known projects. Every single reputable US-based exchange will have you covered here. This is the baseline, the absolute bare minimum. But where things get interesting, and frankly where they get dangerous, is when you move beyond the basics. You start hearing about a new project on Twitter, or a friend tells you about some hidden gem that's supposedly the next 100x coin. You go to your exchange, you search for it, and it's not there. So you think, my exchange is holding me back. I need one with more options, more coins. This is a perfectly logical thought. It's also a trap. The belief that more choice is always better is one of the most pervasive and damaging myths in the crypto world. We're conditioned to think this way. A restaurant with a 50-page menu seems like it has something for everyone, while a restaurant with a one-page, curated menu feels restrictive. But which one usually has the better food? Which one has a chef who has mastered their craft instead of trying to be a jack of all trades? It's almost always the one with fewer, carefully selected options. Crypto exchanges are no different. When you see a platform advertising over 2,000 coins supported, that shouldn't be a point of excitement. It should be a massive flashing red flag. Why? For two critical reasons: regulatory risk and the complete absence of quality control. Let's start with regulatory risk. The United States Securities and Exchange Commission, the SEC, has made it abundantly clear that they believe most crypto assets, aside from Bitcoin and possibly Ethereum, are securities. A security is a financial instrument that represents an investment in a common enterprise with a reasonable expectation of profits to be derived from the efforts of others. Think of a stock. To legally list and trade stocks, an exchange needs to be heavily regulated, like the New York Stock Exchange. Now, most crypto exchanges in the US are not licensed to trade securities. They are licensed as money services businesses, or with state-specific money transmitter licenses. So, when an exchange decides to list hundreds or even thousands of different tokens, they are making a massive bet. They are betting that the SEC won't come after them for illegally operating as an unregistered securities exchange. And that is a very, very risky bet. What happens when that bet goes wrong? We've seen it play out. The SEC sues a project like Ripple with its XRP token. In the aftermath, major US exchanges like Coinbase were forced to delist XRP to protect themselves. Imagine you were an XRP holder on that platform. One day you can trade it, the next day you can't. Your assets are effectively frozen on that platform. You might be able to withdraw them to a private wallet, but you can no longer sell them for US dollars when you want to. Now multiply that risk by 1,000. A platform that lists every new coin that pops up is a ticking time bomb. They are creating a portfolio of immense legal liability. If and when the regulatory hammer comes down, it won't just be one or two coins being delisted. Could be dozens, even hundreds, all at once. The ensuing chaos could lock up user funds, cause the platform to become insolvent, or shut it down entirely. A curated, selective listing policy isn't a limitation. It's a shield. It's the platform protecting not only itself, but you, the customer, from predictable regulatory fallout. The second reason, the lack of quality control, is even more insidious. What does it take for a coin to get listed on one of these everything exchanges? In many cases, not much more than a fee and a functioning block explorer. The platform isn't vetting the technology. They aren't scrutinizing the team for anonymous founders with shady histories. They aren't analyzing the tokenomics to see if it's designed to be a pump and dump scheme. They don't do this because their business model isn't aligned with your success. It's aligned with trading volume. They make money on fees. Every new, hyped-up coin they list brings a flood of new traders and a surge in volume. They are incentivized to list first and ask questions later, if ever. They are, in effect, providing the infrastructure for scams. They're building the casino and handing out free chips to every grifter who walks in the door, knowing the house always wins on the transaction fees, regardless of whether you get wiped out. This creates an environment that is toxic for investors. You're navigating a minefield without a map. For every legitimate early-stage project, there are 100 worthless meme coins, rug pulls, and vaporware projects designed for one purpose: to separate you from your money. A responsible exchange acts as a gatekeeper. Their listing process is a form of due diligence. When a platform like Coinbase or Kraken lists a new asset, it's not an endorsement, but it does mean the asset has cleared a significant number of legal, technical, and compliance hurdles. They have a reputation to protect. An exchange that lists 2,000 coins has no reputation to protect. Its reputation is that it's the Wild West. And this brings us to a crucial related concept: liquidity. Let's say you find an exchange that lists the obscure coin you're interested in. The fact that it's listed is only half the story. The real question is, can you actually trade it effectively? This is where liquidity comes in. Liquidity is just a fancy word for how easily you can buy or sell an asset at a stable price. Think of it like selling a car. If you're selling a 2022 Toyota Camry, there are thousands of buyers. You can sell it quickly at a price very close to the market value. That's a highly liquid asset. Now imagine you're trying to sell a heavily modified 1978 Bulgarian race car. There might only be 3 potential buyers on the entire continent. To sell it, you might have to wait months and accept a price far below what you think it's worth. That's an illiquid asset. On a crypto exchange, low liquidity is a profit killer. It shows up in 2 ways: slippage and spread. The spread is the gap between the highest price a buyer is willing to pay and the lowest price a seller is willing to accept. On an illiquid coin, this gap can be enormous. You might buy a coin at $1.05, but the instant you buy it, the best offer to sell it back is only 95 cents. You've already lost 10% just by entering the trade. Slippage is even worse. Let's say you see a coin trading at $1 and you place a market order to buy $10,000 worth. On an illiquid exchange, there might not be enough coins for sale at $1. So your order starts eating up the order book. You buy the few coins at $1, then the ones at $1.01, then $1.02, and so on. By the time your $10,000 order is filled, your average price might be $1.04. You lost 4% or $400 before you even started. Platforms that list thousands of coins inevitably suffer from fractured liquidity. Their user base is spread thin across all these different markets. The result is that outside of the top 10 or 20 coins, most of their markets are ghost towns. They are liquid nightmares with huge spreads and punishing slippage. A better platform will list fewer assets but will ensure that the assets they do list have deep, healthy, and liquid markets. This saves you money on every single trade and ensures you can get in, and more importantly, get out when you need to. So when you evaluate a platform's coin selection, don't be fooled by sheer numbers. Look for quality over quantity. Ask yourself, does this platform list the handful of assets I am genuinely interested in for the long term? Does their listing policy seem thoughtful and deliberate? Or does it feel like they're just throwing darts at a board? Check the trading volumes and order books for the coins you care about. Is there real activity, or is it a wasteland? Choosing an exchange with a curated selection isn't limiting your options. It's a strategic decision. It's an admission that you can't possibly research thousands of projects yourself, so you're choosing to partner with a platform that does some of that initial, crucial filtering for you. It's a vote for regulatory safety, for quality control, and for liquid, efficient markets. In a space as chaotic as crypto, choosing a walled garden over the Wild West isn't a sign of weakness. It's a sign of intelligence. And that brings us to the fourth and arguably the most personal factor on our list: the user experience and the tools at your disposal. Because let's be honest, you can have the most secure, regulated, low-fee platform in the world, but if using it feels like trying to solve a Rubik's Cube in the dark during an earthquake, none of that matters. A platform's interface is not just about aesthetics. It's about your effectiveness as a trader and, frankly, your sanity. Think of it this way. Imagine you're handed the keys to a brand new Ferrari. The engine is a masterpiece of engineering, it's perfectly safe, the fuel is cheap. But when you get inside, the steering wheel is on the ceiling, the brake pedal is where the radio should be, and to start the car you have to recite the alphabet backwards. You're not going to win any races. In fact, you're probably going to crash before you even leave the driveway. That is what trading on a poorly designed platform feels like. It's a performance vehicle with an impossible cockpit. And in the world of crypto, where seconds can mean the difference between profit and loss, A confusing interface isn't just an annoyance. It's a direct threat to your capital. The very best US-based platforms understand this. They've mastered a delicate balancing act, creating an experience that caters to two completely different audiences simultaneously: the brand new beginner and the seasoned professional. For the beginner, the interface should be clean, intuitive, and almost invisible. The path to buying your first fraction of a Bitcoin should be as simple as ordering a pizza on an app. Big, clear buttons for buy and sell. A simple search bar to find the asset you want. Your balance displayed prominently. It should hold your hand without making you feel stupid. It should strip away all the complex jargon and charting tools by default, presenting you with a calm, orderly environment to make your first moves. This is the simple mode, and its quality is the #1 thing you should look for if you're just starting out. Can you, within 60 seconds of opening the app, figure out how to buy $50 worth of Ethereum? If the answer is no, close the app and move on. But here's the magic trick. A great platform hides a second, more powerful engine under that simple hood. With the flick of a switch, usually labeled Advanced, Pro, or Active Trader, that simple dashboard should transform into the command center of a starship. This is where the platform proves its worth to serious traders. Suddenly, you should see sophisticated charting tools, often powered by TradingView, which is the industry standard. You should be able to overlay dozens of technical indicators, from the relative strength index to Bollinger Bands. You should be able to draw trend lines, Fibonacci retracements, and plot out your strategies right on the chart. This advanced view is also where you unlock the full suite of trading tools, and this is critically important. I'm talking about order types that go far beyond a simple market buy. A market buy just gets you the asset at the current best price, which can be unpredictable in a fast-moving market. Professional platform gives you control. It gives you limit orders, allowing you to set the exact price at which you're willing to buy or sell. Even more importantly, it gives you risk management tools like stop-loss and take-profit orders. These are your automated safety nets. Let's say you buy an asset at $100, and you decide you're only willing to risk losing 10% on this trade. You can set a stop-loss order at $90. If the price drops to that level, the platform automatically sells your position for you, preventing a catastrophic loss, even if you're asleep on a plane or watching a movie. Conversely, a take-profit order lets you lock in gains automatically. If you think the asset will hit $150 and then likely pull back, you can set a take-profit order at that price. Once it hits your target, the platform sells, securing your profit before the market has a chance to turn against you. Platforms that offer even more advanced orders, like OCO, which stands for one cancels the other, letting you set both a stop-loss and a take-profit at the same time, are signaling that they cater to serious users who actively manage their risk. The absence of these tools is a massive red flag. It suggests the platform is more of a simple crypto wallet than a true trading powerhouse. And all of this functionality has to be seamless, especially on mobile. We don't live in a world where people are chained to their desktops anymore. You will be checking your portfolio and making trades from your phone, at the grocery store, at your kid's soccer game, in an Uber. The mobile app experience is not an afterthought. For many, it is the platform. Is the app fast and responsive? Does it crash? Read the reviews in the App Store and Google Play, but read them with a critical eye. Ignore the one-star reviews that say, "I lost all my money on Dogecoin. This app is a scam." That's not the app's fault. Look for patterns. Are dozens of people complaining that the app freezes during peak trading hours? Are there reports of login issues or delayed order execution? These are the real red flags. A platform that hasn't invested in a rock-solid, stable mobile app is a platform that will fail you when you need it most. Finally, a superior user experience includes the little things, the quality of life features that show a company actually cares. How easy is it to see your transaction history? Can you easily track your profit and loss on a per-asset basis? And here's a huge one for anyone in the US. Does the platform offer tools to help with tax reporting? The IRS is no joke when it comes to crypto. Platforms that can generate the tax forms you need, or at least provide a clean, exportable transaction history that can plug into crypto tax software, are providing immense value in saving you a colossal headache come tax season. This feature alone can be a tiebreaker between two otherwise equal platforms. So, when you're evaluating a platform, don't just look at the fee schedule or the list of coins. Open it up. Use the demo account if they have one. Experience it. Does it feel intuitive and empowering? Or confusing and restrictive? Does it give you the simple one-click options for when you're in a hurry? And the granular advanced controls for when you need to be precise? The user experience is the bridge between you and the market. A poorly built bridge will collapse under pressure, but a well-engineered one will give you the confidence to cross any chasm the volatile world of crypto throws at you. But what happens when that bridge has a crack? What happens when an order doesn't execute correctly, or a deposit doesn't show up? Even the most advanced pilot with the most sophisticated jet occasionally needs to talk to air traffic control. And that brings us to our fifth and final critical component, is world-class human-powered customer support. Now, I know what some of you are thinking. Customer support? Really? That's the grand finale? Sounds boring. Sounds like the thing you scroll past in the feature list. It feels like a checkbox item, not a cornerstone. But let me be absolutely clear. In the chaotic 24/7, high-stakes world of cryptocurrency, viewing customer support as anything less than a critical life-or-death feature is one of the most dangerous mistakes you can make. Think of it this way. You wouldn't buy a car without airbags, right? You hope you never ever have to use them. You don't see them, you don't interact with them on a daily basis. But you know that in that one-in-a-million moment of crisis, a sudden, violent, unexpected event, that airbag is the single most important feature in the entire vehicle. It's the difference between a bad day and the last day. That is what customer support is for your crypto portfolio. It's the airbag. It's the fire extinguisher. It's the emergency service on speed dial. Because when things go wrong in crypto, they don't go wrong slowly. They go wrong instantly, catastrophically, and often at 3 o'clock in the morning on a Sunday. Let me paint you a picture. It's a true story of Frankenstein's monster stitched together from hundreds of horror stories I've seen on Reddit, on Twitter, and forums. Imagine it's you. You've been watching a coin for weeks. You've done your research, you've timed the market, and you see the breakout happening. This is it. You log into your account to place your trade, but you're met with an error message. Login temporarily disabled for security review. Your heart starts hammering in your chest. Hey, no big deal. You just need to talk to someone. You go to the help section. There's no phone number. There's no live chat. There's just an email form. You fill it out, your hands shaking slightly, explaining the situation. You hit send, and you get an automated reply. Thank you for your message. Our team will review your ticket and respond within 5 to 7 business days. 5 to 7 business days. In crypto, that's not a lifetime. It's a geological epoch. Entire civilizations of meme coins rise and fall in that time. The breakout you were waiting for is happening right now without you. You watch the charts on another screen. A helpless spectator to your own financial destiny. You send another email. And another. You scream into the void of an unmonitored inbox. By the time you get a generic cut-and-paste response from a support agent named Chad a week later, asking you for information you already provided, the opportunity is gone. The market has completely reversed, and you just missed the single biggest trade of your year because you were locked in a digital prison with no one to hear you rattling the bars. This is not an exaggeration. This is the reality of bad customer support. And the worst platforms have turned it into an art form. They hide behind layers of automated bots, impenetrable FAQ sections, and ticket systems designed to frustrate you into giving up. Why? Because real, competent 24/7 human support is expensive. It is one of the single biggest operational costs for a financial services company. And many platforms make a simple, cynical calculation. They bet that you won't need help until it's too late. So how do we avoid this nightmare? We apply what I call the 2 a.m. test. The crypto market doesn't operate on a 9 to 5 Monday to Friday schedule. It is a relentless, sleepless global entity. The most volatile, most critical moments often happen when the US is asleep. A flash crash, a major liquidation cascade, a sudden regulatory announcement from Asia. These things happen in the dead of night. The 2 a.m. test is simple. If your account is frozen, if a transaction is stuck, if you suspect a security breach at 2 a.m. on a Saturday, what happens next? Can you get a living, breathing, intelligent human being on the line in under 5 minutes? If the answer is no, that platform fails the test. Here's what to look for: the anatomy of a platform that passes the 2 a.m. test with flying colors. First, multiple channels of communication. A platform that takes support seriously will offer at least 3 options: email, live chat, and telephone support. Email is for non-urgent issues, for creating a paper trail. Live chat is for quick, simple questions where you need an answer now, but it's not a 5-alarm fire. But the gold standard, the non-negotiable feature for any serious trader, is phone support. When your money is on the line and every second counts, you need the clarity and immediacy of a human voice. The ability to talk to a person, explain a complex problem, and get real-time feedback is priceless. If a platform doesn't have a phone number listed prominently on their site, consider it a massive red flag. It means they don't want to talk to you when things get tough. Second, 24/7 availability. Not a 24/7 bot. Not a 24/7 FAQ page. We're talking about 24/7 access to human beings. Check the fine print. Many platforms will say 24/7 support, but what they mean is you can submit a ticket 24/7. That's like saying a restaurant is open 24/7, because you can slip a note under the door anytime you want. You need to know that no matter when crisis strikes, someone is there to pick up the phone or answer the chat. Third, and this is especially crucial for a US-based audience, US-based support. When you're dealing with a complex issue involving US tax law like questions about a 1099-B form, or trying to navigate a state-specific regulation, or dealing with an ACH transfer from a US bank, do you want to talk to someone in a call center halfway around the world reading from a script? Or do you want to talk to someone in your own country who understands the nuances of the American financial system, who works in your time zone, and who can provide clear, actionable advice without a language barrier? US-based platforms that invest in US-based support are signaling that they understand their target audience and are committed to providing a higher caliber of service. Finally, and most importantly, competence. It's one thing to get a human on the phone. It's another thing entirely to get one who can actually solve your problem. The world is full of Tier 1 support agents whose only job is to apologize, express empathy, and escalate your ticket. This is a delaying tactic. What you need is a support team that is deeply knowledgeable about the platform, about blockchain technology, and about financial transactions. So how do you test this before you've committed thousands of dollars? You conduct a pre-flight check. Before you make a major deposit, test their support system. Call them up. Start a live chat. Ask them a reasonably complex but legitimate question. Don't ask, "What's my password?" Ask something like, "Can you explain the difference in how your platform handles stop limit versus stop market orders during periods of high volatility?" Or, "What is your exact policy and procedure for recovering funds sent to a wrong but compatible network address? For instance, sending an ERC20 token to a Polygon address." Their answer will tell you everything you need to know. Do they give you a clear, confident, correct answer? Or do they put you on hold for 10 minutes and come back with a link to an FAQ article? Do they sound like they understand the product? Or like they're just reading a script? The quality of that one interaction is a crystal ball that will show you exactly what you can expect when you have a real problem. So let's recap the 5 pillars we've built. We started with the fortress, ironclad security. Then we examined the engine, fair and transparent fees. We explored the inventory, a diverse and compliant list of tradable assets. We learned to fly the plane with an intuitive user interface and powerful tools. And now we've established our lifeline to air traffic control, world-class customer support. Each of these 5 pillars is essential. A platform can have the best fees in the world, but it's worthless if it gets hacked. It can be the most secure platform ever built, but it's useless if it's so complicated you can't figure out how to place a trade. They are all interconnected parts of a single machine, the machine you are entrusting with your hard-earned capital. So now we have the complete 5-point checklist. We have the blueprint. We know what to look for. But this raises the final, most important question. How do you put it all together? How do you weigh these 5 critical factors against each other to find the one platform that isn't just good, but is perfect for you, for your goals, your risk tolerance, and your trading style? In our final part, we're going to build your personal decision-making framework. We'll move from theory to practice, and I'll show you how to score and compare real-world platforms using this checklist, ensuring you make the right choice. And we'll reveal the single biggest mistake that even savvy traders make after they've chosen their platform, a mistake that can undermine all the careful research you've done. So what is that one catastrophic mistake? It's treating your exchange like a bank. It's the belief that once you've bought your Bitcoin, your Ethereum, your crypto, that the platform you bought it on is the safest place to keep it. This is, without a doubt, the most dangerous assumption in the entire crypto space. And it's rooted in a fundamental misunderstanding of what ownership truly means in this new digital world. Let me be crystal clear. When you leave your crypto on an exchange, you do not truly own it. You have an IOU. You have a promise from a company that they are holding your assets for you. You are trusting a centralized entity with a decentralized asset. It's like buying a bar of gold and then leaving it in the dealer's showroom, hoping they'll be there tomorrow when you come back for it. We've seen this story play out time and time again, like a tragic opera on repeat. Tigox, Quadragasix, Celsius, Voyager, and of course the Titan that fell, FTX. Thousands, even millions of users did everything right. They researched the platform, they made smart trades, they built their portfolios. And then one morning they woke up to a headline, an email, a frozen withdrawal button, and in that single moment their crypto, their hard-earned assets was gone, locked away in bankruptcy proceedings, commingled with company funds, or simply vanished. The reason is simple. These platforms hold the private keys to the wallets containing your crypto. In the world of blockchain, whoever holds the keys holds the crypto. It's the ultimate form of control. This is the origin of the most important mantra you will ever hear in this space. Not your keys, not your crypto. Choosing a secure, regulated US-based platform is the critical first step. It dramatically reduces your risk. But the final step in securing your future is taking self-custody of your long-term holdings. It means moving your assets off the exchange and into a personal wallet where you, and only you, control the private keys. This could be a hardware wallet, a small physical device like a ledger or a Trezor, or a software wallet on your computer or phone. Think of it this way. The exchange is the bustling marketplace. It's where you go to buy, sell, and trade. It's busy, it's efficient, but it's not your home. Your personal wallet is your personal, impenetrable vault. It's where you store your wealth for the long term. You only bring to the market what you are willing to trade, and the rest stays locked safe in your vault. Failing to make this distinction, this separation between your trading capital and your stored wealth, is the single biggest mistake that can turn a brilliant investment strategy into a devastating loss. All your hard work in picking the perfect platform becomes meaningless if the platform itself becomes the single point of failure. So, as we wrap this up, let's bring it all together. We've built the ultimate 5-point checklist, a battle-tested framework for choosing the right US-based crypto platform, your command center for navigating this market. This isn't just a list. It's a shield against risk and a foundation for growth. First, we establish the non-negotiable bedrock: regulatory compliance and security. This is your primary line of defense. You must ask, is this platform registered as a money services business with FinCEN? Does it have the necessary state-by-state licenses like the New York BIT license, which is one of the toughest in the world? You're looking for a fortress, not a beach house in a hurricane. This means scrutinizing their security protocols. Two-factor authentication is the absolute minimum. You want to see things like address whitelisting, which prevents funds from being sent to unapproved addresses. And critically, you need to understand their insurance. Is your USD cash balance FDIC insured up to $250,000? What about their digital asset insurance? Do they conduct regular, transparent proof of reserves audits to prove they hold customer assets one-to-one? A platform that is cagey about its compliance or security is a glaring red flag. In this game, transparency isn't a feature. It's the price of admission. Second, we dissected the silent portfolio killer: fees, spreads, and total cost. A platform can look cheap on the surface but hide its costs in the fine print. We went beyond the simple maker-taker fee model. You have to be a detective. What are the deposit and withdrawal fees, both for cash and for crypto? Some platforms will charge you a hefty percentage just to move your own assets off their system. And then there's the spread, the difference between the buy price and the sell price. A platform with zero trading fees might build in a massive spread, meaning you're overpaying for every single purchase and getting less for every sale. The only way to win is to understand the total cost of a round-trip trade. You need to map out your entire process from putting dollars in to trading to taking your crypto out, and calculate every single fee along the way. The best platforms are upfront and transparent about their entire fee structure. Third, we explored the engine of opportunity: asset selection and liquidity. It's a delicate balance. You want a platform that offers the specific coins and tokens you're interested in, but not one that lists every new, unvetted meme coin under the sun. A curated selection often signals that the platform does its due diligence. But the number of coins is only half the story. The other, more important half is liquidity. Liquidity is the lifeblood of a market. It means there are enough buyers and sellers at any given time that you can execute your trades quickly and at a predictable price. On a low liquidity platform, a single large order can cause massive price slippage, meaning you end up paying far more or selling for far less than you intended. You can gauge liquidity by looking at the 24-hour trading volume for the specific pairs you want to trade, and by examining the order book to see how deep the bids and asks are. High liquidity means a healthy, efficient market. Fourth, we focused on your cockpit, user experience and trading tools. A platform is a tool, and the right tool depends on the job. Are you a beginner who just wants a simple, clean interface to buy and hold? Or are you an experienced trader who needs advanced charting tools, a full suite of order types like stop loss and take profit, and maybe even API access for automated trading? The best platforms often cater to both, offering a simple mode and an advanced or pro mode. Test it out. Does the mobile app have full functionality? Is the website intuitive or cluttered? A clunky, confusing interface can lead to costly execution errors. Your platform should feel like an extension of your strategy, empowering you to act decisively, not fighting you every step of the way. And finally, the fifth and often most overlooked element, customer support and education. When things go wrong, and in crypto they sometimes do, you need to know someone has your back. A frozen transaction, a login issue, a question about a feature. Waiting 3 days for an email response is not acceptable when your money is on the line. Look for platforms that offer 24/7 support through multiple channels, like live chat or even a phone number. A robust, searchable help center is also a must. Beyond just fixing problems, great platforms invest in their users' success. They provide high-quality educational resources, market analysis, and tutorials that help you become a smarter, more informed investor. A platform that teaches you how to fish is far more valuable than one that just sells you fish. This 5-point framework, compliance, cost, coins, cockpit, and customer care, is your comprehensive guide. It transforms you from a passive participant into a discerning consumer. You are no longer just picking an app. You are selecting a financial partner. You are building the foundation upon which your entire crypto journey will rest. The power is now in your hands. You have the knowledge that 90% of people entering this space lack. You know how to vet a platform for security, how to dissect its true costs, how to evaluate its market health, and how to ensure it fits your personal strategy. And most importantly, you now understand the critical difference between buying crypto and truly owning it. This journey into digital assets is one of the most exciting financial revolutions of our lifetime, but it demands diligence. It demands responsibility. By following this guide, you're not just protecting your capital, you're positioning yourself to thrive in the future of finance. If this guide gave you even one piece of information that could save you from a costly mistake or help you find the perfect platform, do us a small favor and hit that like button. And to join a community of smart, informed investors who are serious about building wealth in the digital age, make sure you subscribe and turn on notifications. We have so much more to share with you. Now I want to hear from you. Drop a comment below and tell us, what is the #1 most important feature you look for in a crypto platform? Or if you're willing to share, what's the biggest mistake you've made that others can learn from? The collective wisdom of this community is our greatest asset. Thank you for investing your time with us today. Now go build your future.